So imagine you see a stock that has completely crashed. I mean, dropping from a dizzying $268 all the way down to a mere $7.
Right, which is just a brutal, brutal fall.
Exactly. And usually the market narrative there is pretty straightforward, The company failed, the model is completely broken, and bankruptcy is imminent. You just close the book and move on.
Yeah, normally you wouldn't give it a second look.
But then you look at Strive Inc., ticker symbol ASST. It hit that $7 floor, and instead of just dying like you'd expect, it suddenly started flashing these massive strong buy signals across the board from Wall Street desks.
Oh, yeah, and the target prices they're setting are like 90% higher than current levels. It's wild.
Which is exactly why we are in this deep dive. Our mission today is unpacking that exact paradox. Are you looking at a deeply misunderstood hidden gem? Or is this just a massive, sophisticated value trap?
A trap engineered to, provide exit liquidity for institutional holders. It happens all the time.
It really does. So we are tearing into the filings, the insider trading logs, and the raw order flow of ASST as of April 15th, 2026. But real quick, before we start, please make sure to like the video, subscribe to our YouTube channel, and leave your comments and feedback. It's compulsory.
Yes, definitely do that. And I should add a firm disclaimer right up front here. This deep dive is strictly an educational debate based on data. We're looking at corporate strategy and market mechanics. This is absolutely not financial advice, so please don't take it as such.
Okay, let's unpack this. We've got this massive volatility with ASST. I mean, the stock just closed at $13.53 after a really strong daily gain of 8.85%.
Which is a solid day by any metric.
For sure. So it's hovering way above that 52-week low of $7.02. But still, it is astronomically far from its 52-week high of $268.40.
Yeah, it's not even the same zip code anymore.
No, not at all. So how does a company lose that much value, basically fall off a cliff, but still generate so much recent buzz?
Well, to understand the sheer velocity of that drop from 268, you have to look under the hood at the 2025 financials.
Right, because something fundamentally broke there.
Exactly. They reveal this massive identity crisis. The company essentially stopped trying to be whatever it was before, and they executed a massive strategic pivot.
And the numbers are just jaw-dropping. I mean, looking at the fiscal year 2025 income statement, it's like a masterclass in accounting shock value.
Oh, it really is. It's almost hard to believe when you first read it.
Yeah, so get this. Strive reported total revenue of just $5.73 million. I mean, $5.73 million for a public company is practically a rounding error.
Right, it's nothing.
But the net income figure, or rather the net loss, is a staggering $420.59 million.
Which is just a massive crater on the income statement.
Totally. That drags their trailing 12 months earnings per share down to a negative $8.43. It honestly looks like a bakery that sold a few $1,000s in cupcakes, but somehow managed to burn down a $400 million kitchen.
That is a great way to put it. But what's fascinating here is why those losses are so extreme. Because that cash wasn't actually burned in the way you might think.
Wait, what do you mean? How do you lose $420 million without burning it?
Well, it wasn't an operational cash burn from, trying to sell software or whatever they were doing. Strive effectively transformed into a holding vehicle. They pivoted entirely to a Bitcoin treasury strategy.
Oh, wow.
Yeah, they went out and acquired over 7,500 Bitcoin for their corporate treasury.
Okay, so that changes the picture entirely, because now you are dealing with the brutal reality of digital asset accounting.
Exactly. When you hold 7,500 Bitcoin, your income statement is suddenly at the absolute mercy of crypto market volatility.
Right, because under current financial accounting standards, if the price of Bitcoin drops even just temporarily below your purchase price during that reporting period, you have to record it.
You are required to record an impairment charge, yes.
And that registers as a massive loss on the income statement, even if you didn't sell a single coin.
Right. Think of it like checking your home's value on Zillow during a housing slump.
Oh, that's a good analogy.
Yeah, like if the algorithm says your house dropped 20%, your net worth on paper looks terrible. But unless you actually panic and sell the house that exact day, you haven't lost a single dime from your bank account.
So Strive was essentially forced to mark down the value of their treasury during a crypto dip, which created this apocalyptic net loss that doesn't actually reflect their daily business operations.
Precisely. And that distinction points us directly to the balance sheet. because when you strip away those paper impairments, the structural reality is surprisingly sturdy.
It really is. I mean, on paper, they are sitting on total assets of $745.53 million.
Which is largely propped up by the sheer volume of that Bitcoin reserve, of course.
Right. And they actually have $67.5 million in total liquid cash just sitting in the bank.
Yeah, that's real money.
But the metric that stands out the most to me is their leverage. Their debt to equity ratio is sitting at just 0.57%. That is incredibly low.
It's basically non-existent.
Yeah.
They have practically zero debt, which means they aren't answering to bondholders, and they don't have these massive interest payments eating up their cash.
Okay, so on one hand, the balance sheet looks like a fortress. But on the other hand, the cash flow statement tells a completely different story.
Well, the cash flow is bleeding. Having zero debt and a huge digital vault is a great defensive posture, sure.
Mm-hmm.
But a business still has to, pay employees, cover administrative costs, keep the lights on.
Right, you can't pay your electric bill with an unrealized Bitcoin gain.
Exactly. The balance sheet is a static snapshot, but the cash flow statement measures the actual oxygen in the room. And right now, Strive is suffocating.
Yeah, let's look at those numbers. The operating cash flow is sitting at negative $43.19 million, and the levered free cash flow is negative $132.47 million.
It's heavy.
So even though they aren't losing $400 million in literal cash, they are still bleeding tens of millions of dollars just to exist day to day.
Which creates a serious ticking clock. If you are burning $43 million in operating cash, that $67 million cash reserve we talked about, it starts looking very, very small.
Oh yeah, at that burn rate, they have less than a year and a half of runway before they literally hit zero liquid cash.
Which is exactly the kind of thing that sends retail traders running for the hills. Nobody wants to catch a falling knife when the company have a one-year runway.
But that is what makes the recent price action so bizarre. If the cash flow is bleeding that badly, who on earth is buying this stock right now?
To answer that, we have to follow the smart money. You look past retail sentiment, and you track the institutional and insider activity.
Right, the people who actually know the internal math. And looking at the logs, the top brass at Strive are absolutely eating their own cooking.
The insider buying is incredibly aggressive right now.
It really is. Let's look at the CEO, Matthew Ryan Cole. In January 2026, he stepped in and bought 25,000 shares with his own capital at $18.40.
Which is a serious vote of confidence on its own.
But then, 2 months later, in March, the board awarded him 702,900 restricted stock units, or RSUs.
Right, and RSUs are a crucial alignment mechanism. You just don't hand a CEO over 700,000 unvested shares unless the board expects that equity to appreciate significantly.
Because it locks his net worth directly to the long-term recovery of the stock price.
Exactly. But honestly, the trade that carries the absolute most weight for me is from the CFO, Benjamin Pham.
Oh yeah, the February purchase. He bought 6,200 shares at $8.10.
Which is just pennies away from the absolute 52-week low of $7.02.
Why is that specific trade so important?
Because the chief financial officer is the architect of that ticking clock we just talked about. He's the one guy who knows exactly how fast the cash is burning. He knows what vendor payments are due and when the bank accounts hit zero.
Right, he has the raw data.
So when a CFO deploys their own personal capital that close to the multi-year low, it usually signals a massive internal belief that the bottom is firmly in. A CFO just does not buy equity in a company that's going to miss payroll in 6 months.
That makes total sense. And you also have Vivek Ramaswamy, who is a 10% owner, purchasing $1.3 million worth of preferred stock back in November 2025.
Which is another massive signal. Preferred stock sits higher in the capital structure. So he secured a downside-protected position while still projecting massive confidence in the asset base.
Okay, so the insiders are clearly treating this like an accumulation phase for a treasury vault, not a failing tech company.
Right, but insider confidence doesn't move markets on its own. We have to see if the charts and the Wall Street analysts actually agree with him.
Well, let's dive into the technical analysis. It's basically painting a picture of a brutal pug of war. You've got the long-term trauma of that crash from $268 fighting against a very violent short-term reversal.
Yeah, the short-term chart is showing a lot of bullish momentum.
Definitely. Right now, at $13.53, AST is trading comfortably above its 5-day moving average of $12.97. And more importantly, it's above its 50-day average of $10.87.
And breaking that 50-day moving average is critical. The 5-day is just noise, mostly algorithmic traders, But the 50-day represents swing traders and medium-term sentiment.
So clearing that $10.87 hurdle confirms the trend has shifted.
Exactly. It shows a shift from distribution to accumulation, but they still have a massive structural ceiling overhead.
Oh, you mean the 200-day moving average, which is sitting way up there at $42.71.
Yes, that 200-day average is essentially the psychological graveyard of this stock.
The graveyard.
Yeah, it represents all the institutional trend followers and long-term holders who are currently trapped underwater from that massive collapse.
Oh, right. The people who bought in the hundreds.
Exactly. So every time the stock rallies toward that level, you're going to see massive selling pressure from investors who are just desperate to break even and exit. It acts as a heavy lid on the chart.
Makes sense. Now, looking at the immediate term, the order flow is showing heavy buying pressure concentrated near the $12.54 pivot level.
Right, which is providing a strong baseline. And if you're watching the momentum, the key resistance levels to watch are $13.64, that's R1, then $13.94 for R2, and $14.44 for R3.
And what if the rally fails? Where is the support?
Crucial support is holding at that $12.02 pivot. Below that, you have $11.09, and then, of course, that critical 52-week low of $7.02.
Okay, but we need to issue a pretty big warning here because there is a glaring red flashing light in the momentum indicators.
Oh, you're talking about the RSI.
Yes, the 14-day relative strength index is currently sitting at 75.98.
Which is deep into overbought territory.
Exactly. Even though the MACD is sitting at 0.645, which is an active buy signal, you just cannot ignore an RSI pushing 76.
No, you really can't. When an asset gets that technically stretched, the buyers are historically exhausted. It highly suggests a short-term pullback, or at least a period of consolidation near that $13 level.
It has to cool off before it can push higher.
Right. But despite that overbought warning and the terrible cash flow, the Wall Street consensus is completely ignoring the bearish structure.
They really are. I mean, I was looking at the analyst ratings, and surprisingly, it is a strong buy to moderate buy consensus.
Which is staggering when you look at the operations.
Totally. The average price target is $19.33, and TD Cowen just placed a high target of $26 flat.
$26.
Yes. That indicates a potential 90% upside from where we are right now.
So Wall Street is looking at a company bleeding $43 million in cash and saying, yeah, this should nearly double in value.
Which naturally brings us to the ultimate debate for you as an investor. Is this a deeply undervalued proxy for Bitcoin or a classic value trap designed to crush retail traders?
That is the core valuation debate right there. Because synthesizing these contradictory metrics requires deciding what Strive Inc. actually is at this point.
Right, because if we evaluate Strive as a traditional operating company, the value narrative completely falls apart.
Well, it crumbles instantly.
Just look at the price-to-sales ratio. The trailing 12 months PS sits at an eye-watering 79.71.
Which is absurd. I mean, a healthy, high-growth tech darling might trade at a PS of like 10 or 15.
Exactly. At nearly 80, you are paying almost $80 for every single dollar of actual revenue the company generates. For a company making less than $6 million in revenue, a PS of 80 is dangerously overvalued by traditional metrics.
It is entirely indefensible if you were buying the revenue stream. But that brings us to the bull case.
Okay, let's hear the bull argument.
The bullish argument, and the reason TD Cowen has a $26 target, is that you aren't buying that $5.7 million revenue stream anymore. Strive is basically no longer a software or services company.
So what are they?
They have effectively become an unregulated, leveraged Bitcoin ETF disguised as a tech stock. You are buying direct, equity-based exposure to the 7,500 Bitcoin on their balance sheet.
Ah, so the stock is essentially just a wrapper for the Treasury vault.
Precisely. If the macroeconomic environment pushes Bitcoin into a massive bull run, the value of that $745 million asset base inflates dramatically. So AST acts as a leveraged growth proxy. The analysts aren't predicting that Strive will suddenly sell $50 million in software. They are predicting the underlying Bitcoin will surge.
Okay, I hear that. But let me counter with the bear case, because there are massive downside risks here.
Well, for sure. Go ahead.
First of all, AST is now entirely correlated to Bitcoin. If Bitcoin enters a prolonged bear market or crashes, AST collapses right alongside it. There is no profitable underlying business to act as a shock absorber.
Right. $5 million in revenue won't save you if the Treasury drops by 50%.
Exactly. But honestly, the correlation isn't even the most dangerous part. The real danger for retail investors here is the massive dilution risk.
Yes, the dilution death spiral.
Right. Because, going back to the cash flow, they are burning $43 million in operating cash, and they only have $67 million in the bank. They likely won't get a traditional bank loan with that kind of cash bleed.
Which means they will likely need to raise capital in the future through the public markets.
Exactly. And this is how retail traders get trapped. A retail trader looks at the chart, sees the $26 target from TD Cowen, buys into the hype at $13, and thinks they're getting a steal.
And then the company realizes it has to pay its electric bill.
Right. So the company hires an investment bank, files a secondary stock offering, and issues millions of new shares to the public at a steep discount just to raise cash.
And that instantly floods the market with a massive supply of tradable shares.
Yep. The stock price plummets to match the new supply. Existing shareholders are massively diluted, and the retail investor is left holding the bag while the company uses their money to fund the next year of operations.
It's a brutal cycle, but it happens all the time.
Unless they decide to start liquidating their Bitcoin to fund operations, which completely defeats the whole treasury proxy strategy, that secondary stock offering feels like a statistical inevitability.
It really does, which is why synthesizing the outlook here requires looking at two very rigid timeframes.
Okay, break it down. What's the short-term outlook?
Short term, based on the technicals and order flow, it's neutral to bullish. The moving averages have crossed into accumulation, the MACD is signaling buying pressure, and the insiders have really anchored the floor.
Yeah.
But expecting a slight pullback to cool off that 76 RSI is highly likely before we see any further gains. It needs a period of consolidation.
And what about the long-term outlook?
Long term is bullish, but it is highly conditional. Analysts only see a reversal to that $19 to $26 range if the underlying Bitcoin strategy pays off and outpaces their cash bleed.
Right. It's a pure macroeconomic play now. The legacy fundamentals of the business just do not apply anymore. So what does this all mean for you listening to this? You're looking at a company that has essentially burned its boats on the shore. The only thing dictating the survival of AST is that digital vault.
Yep, they are completely tethered to it.
Which leaves us with a final, somewhat calculated thought for you to explore on your own. Since AST is now entirely at the mercy of its treasury, would you like to monitor the specific Bitcoin price levels that might trigger the next major move for AST?
It's definitely the question you have to ask if you're watching this stock.
Absolutely. Thank you all for joining us on this deep dive, and we'll catch you on the next one.